Hey everybody, this is Brant. How you doing? Is anybody out there? Give me just 1 second. I'm gonna try to get the comments up on the screen that I've been having such a difficult time with, but I think I figured it out. So pretty pretty crazy week so far. I think the market definitely seemed a lot more I guess I would say volatile. It seemed a lot more negative than it actually was, which I found to be a little bit interesting. Yeah, I guess this comment thing is not going to work out. All right, I have to watch them on my phone. So anyway, yeah. So last week, I had the video, and the premise was, look, we're going into the FOMC. Let me adjust this a teeny bit. We're going into the FOMC, and as it was leaked to Nick Timiraos from the Wall Street Journal. He's kind of like the unofficial Fed mouthpiece. So they're in media blackout before the FOMC meeting, so they can't say anything, right? But they never want to surprise markets. So what had come out the last week, was an article from him saying that whether the Fed hiked 25 basis points, and that's down from 50 because of everything that happened with the banks. 50 was like a granted several weeks back. Whether they go 25 or whether they stop depended on how the market, more specifically the banks, acted. The banks did fine Monday, Tuesday. The market did fine enough, and the Fed went ahead with the 25 basis point rate hike. If you watched Wednesday, the market had, its typical knee-jerk reaction, but it actually liked what Powell said. It liked what the FOMC statement said. And then Janet Yellen, the Treasury Secretary, chimed in, and everything went to crap like in a second. So it was an interesting week. Anyway, let me pull up some charts here and just go through a couple of the just checking my notes for you. Yeah. Oh, yeah. So the Fed's new strategy is this. They're hoping that financial conditions will tighten without them. So what that means is they're hoping this mini bank crisis and it already is going to raise credit standards, and it's going to lower the amount of lending that the banks are doing, right? So they're hoping that is going to put a pinch on the consumer, and that's going to cause the economy to go into a recession, and a recession is deflationary by nature. So they're kind of hoping that this little mini crisis is going to do the work for them. But on the other hand, they can't let it get out of control into a financial crisis. So we had more signs of that this week, right? So week before, it was Credit Suisse's CDS, and that just exploded, like their risk, their counterparty risk, and how the market viewed their credit. It was just like crap. And then this week, it was Deutsche Bank. I mean, come on. These are like the usual suspects, at least with European banks. Uh, I am looking at my chat and just seeing if anybody is out there with me. Yes, okay. I really gotta get this chat thing straightened out. I'm sorry, guys. Let me just disconnect this so I can see it better. Pop out chat window. Let's see who's here. Hey, Dennis. Good morning. Toy. Sound is good? Okay, cool. Cool. Good to have you guys here. Okay, so anyway, let's take a look at a couple charts real quick. All the averages closed up on the week, I think, except maybe small caps. We'll take a look. Let me just go right to the chart here and get off the camera. So here we go, and that's a random chart. We're not looking at KRE right now. So let's take a look at the S&P. Gained 1.4% on the week, believe it or not. And here we go with, so I just want to point out a couple things real quick. These are moving averages. This is what technical traders pay attention to. They don't have any, magic abilities on their own. Technical traders see them and they react. So you can see like this 200-day in dark blue, or maybe you can't see it. That's a horrible color for a black screen, isn't it? But you can see the support there, right? And then you can see when it breaks support. Then when something breaks support, it becomes resistance until breaks above again, then it becomes support again. So you can see this 200-day has just been an important level. But additionally, we have this 50-day right over here that is acting as resistance. So we're getting kind of like this narrowing range between the 200-day is support, the 50-day is resistance, and the 100-day is kind of acting as resistance support on the close, you know. So we did close just right above that. So anyway, kind of surprising to me with all the volatility, you know, up 1.4% on the week. Let me show you the intraday chart real quick. Yeah, this is going to look like a mess for a second because so we did have, you remember, we did have a bull flag over here. And then I kept warning, like, you know, the longer bull flags go on, especially past like 3 weeks, so past 3 weeks would be right here, you know, it gets more dangerous because there's a higher probability of them failing. And a bull flag is just a retracement. It's a bullish retracement. It's a consolidation continuation pattern. It shouldn't retrace all of this, you know, it just should do something like that. So there was a chance maybe we had a head fake here and it popped back in, but nope. At this point, I see no bull flag whatsoever, but I do see price respecting this channel, and I'm going to zoom in and this 4,000 level right here. So I'm just going to zoom in a teeny bit, and maybe a 15-minute chart would be the best. So you could see this week starts right here, the 20th, right? And here's the Fed. So on the Fed day, price traversed this entire channel, right? Tries to bounce up through 4,000, which is just more of a psychological level of resistance right now. Plus, it's where, you know, a lot of the contracts are going to be with options and stuff. So zoom in a little bit closer. I want to show you the Fed day. I'm going to have to back up a little bit. So here's, you know, going into the Fed, typical kind of drift, slightly higher because volatility is usually under pressure. Why is volatility under pressure on Fed days? I've seen this for like, I don't know, I've noticed it for at least a decade. And I remember in 2000, it wasn't 2011, maybe like 2016, 17, something like that. Anyway, the minutes from I think it was a 2011 meeting when Powell was on the FOMC, but he wasn't the chair. Powell was quoted in those minutes as talking about their short position in volatility, which was kind of an interesting thing. So anyway, my theory is that what happens is the Fed, specifically the New York Fed, their open markets trading desk, steps into the market and starts selling volatility about 24 hours ahead of major Fed announcements. And the reason being is, you know, the Fed, they have a lot on their shoulders when they're making announcements like, hey, if we say the wrong thing, the market can crash. So if you dampen volatility, you dampen these price moves. So I guess you would kind of give the voting members like an opportunity to kind of make their decision without the fear of, oh, what's the market going to do? The market's still going to, you know, do its knee-jerk thing, as you can see. But I think that's why. And I've seen this just so consistently for so long that it's just not coincidental to me. In any case, here's 2 p.m. on Wednesday. That's the FOMC announcement. I always say stocks will knee-jerk. The initial knee-jerk reaction is almost wrong. Here's the initial knee-jerk reaction. I always advise to watch the dollar and watch 2-year yields. Okay, stocks are like the least sophisticated market compared to the FX market, to the fixed income market. But in any case, remember what I said about that former bull channel, which is these two big lines right here, still acting. Price is still respecting that, even though it's not a bull flag anymore. We come right up to here. This is Powell's press conference, and here is Janet Yellen's foot in the mouth. I'm not even going to go through that. You can look it up, but yeah, Janet Yellen pretty much stole the jelly out of Powell's donut and sent the market right down to the bottom of that. So here we go, Friday with a little bounce, you know, because Janet Yellen called kind of an emergency meeting. So in any case, bounce up to 4,000, could close above it. Again, you can just see why that 4,000 level is important psychologically speaking. So from there, let's take a look at our next one, which is the Dow. Dow's not my favorite by any means. And it's still managed to close up. Let's see. Well, I can tell you real quick. 1.2%. So here we are, 200-day moving average. Dow really can't get above it. Got above it one day this week, came back down. If you kind of just back this out just a little bit and you just look at this area, this looks like a bear flag to me. And it looks like a bear flag. I noticed it on the intraday charts first. So if we just pop over to those real quick, I'll show you what I mean. Let's see if I have it on 5 or 6. I think I have it on 5. Boom. Okay. This is what I'm talking about. So here's the flagpole, the steep decline. It started out as a real narrow flag, and then it got a bit bigger, right? And then it broke down on Yellen right over here. So this is not a good look at all. All right. S&P is stuck between a whole bunch of technical and psychological resistance zones. So it's a really interesting index to watch right now. But the Dow, I'm not loving at all over here. And just give me 1 second. We'll go to the next one, which is NASDAQ. My favorite, right? I've been a big fan of the NASDAQ all year. So let's see which one we want. 60-minute chart. That's going to be number 6. So NASDAQ is like one of the few, like here, watch, I'll pull up the S&P 500. S&P 500 did have a bull flag, broke down, right? I'll pull up IWM. There it is. Did have a bull flag. It broke down. NASDAQ 100 does have a bull flag. It broke out. So much, much better price performance from NASDAQ 100. If we kind of zoom in a little bit, you can see in the bull flag, I mean, this is how you know a stock continues to trade well, is just watching the intraday price action. So I talked about this last week. When NASDAQ went up and made a bull flag, the other averages went down and made a bear flag. This was the only one that had a bull flag. So we had kind of a measured move, right? I'm just doing this kind of roughly, right? So about 4.4%. And here we go here. 4%. Well, if we go up here, 4.3%. I mean, these measured moves are incredible how accurate they are. Make sure you have that on a log chart if you're going to do it that way. You can put it on an arithmetic chart. Oof, that was bad. And then just count points. But for me, this is easier. In any case, if this bull flag, this next leg right here, which was stymied by Yellen right here, if it does break out, it should go well above 13,000. And that will give us a solid breakout from this larger bull flag right here. So here is the issue. We hadn't made a higher high yet. So we have the breakout, but I'll feel much more comfortable with the NASDAQ. Like, yeah, here we go on this rally when it makes a higher high above this early February high over here. Okay. So, like I said, the measured move would be above 13,000. So it seems like it should. It's just Janet Yellen can't keep her foot out of her mouth. Let me check the comments real quick. Okay, are you of the same opinion about regional banks? Yeah, I'm going to talk about regional banks for sure. What does the 2-year yield symbol? Oh, what is the 2-year yield? I think you have to have the upgraded data package to get the 2-year yield, other than just kind of looking it up on, like CNBC. So the other ones, like at least in Warden here, are like the 5 years FVX. So I think like if you use TOS, Think or Swim, you just put in FVX, not the -X, and then the 10-year is TNX. And you can see you don't want these on a log chart either. So you can see levels like here, it says 38. That's actually 3.80%, or up here, 4.0%, and then the 30 years TYX. And yeah, we'll get to I guess let's just point this out real quick. What I've been saying is, this was the hot February jobs report, and then all that hot data sent yields going up. It sent the market consolidating. So this entire time, the NASDAQ made a bull flag. So if this had happened last year, the NASDAQ wouldn't have made a bull flag. It would have been down like 8 or 10%. So it's acting much better. But what I was saying was, before we got to this point, while we were still trending higher, was that the window of opportunity for stocks, and most specifically the mega caps that are in leadership right now, is this trend line breaking. And despite all of this volatility, I mean, we had, let's see, 1, 2, 3, 4, 5, almost 5 weeks to build this massive, massive rise in yields, and it was taken apart and retraced in 2 days. So that's the bond volatility. Yields lower is more helpful for the mega caps, but I think so long as, we're like below 3.75 on the 10-year, this is the window of opportunity for them. Let me just take a quick look and we'll move on again. I really wish I could get this comment thing sorted out. Okay, so let's take a look at IWM, small caps, and whew. So IWM has got, it's small caps. It doesn't have any of the exposure to the mega caps that are leading, and it has a lot of exposure to the regional banks that are the point of focus of trouble. So IWM, former bull flag, broke down. The only really interesting thing is that the week before, here's the banking crisis, and that was Monday the 13th, right? So last week, the interesting thing was that at least it held that low. Let me back out just a little bit. At least it held that low. And then we saw it break below Thursday and Friday, but guess what? It closed right back above Friday. So interesting thing there, something to watch. That could be potentially a bear trap. And if it was, wow. I'll get to why I think the banks could rally, but it's a major speculative rally. It's almost like trying to catch a falling knife in the meantime until it starts. So it's not one of my favorites unless you really treat it as a speculative trade, which means you have a good stop. It can be tight, it can be loose, whatever, as long as your position size, reflects that. So if you have a wider stop, then you need a smaller position size. If you have a tighter stop, you're more likely to get stopped out, but you can have a larger position size. So guess what? Once again, the mega caps led this week. So if we look at the mega cap index, and it's going to look a lot like the NASDAQ with that bull flag. And even if we jump in closer, the small bull flags I was talking about. So it's doing really well. And the mega cap index was up 1.63% for the week. The S&P equal weight was up 0.8%. So the mega caps more than doubled what the S&P equal weight index did. So they're still leading. They're still showing leadership, even on weeks when they're not really in favor. Because this week, early on, there was kind of more of a rotation. So last week's big winners were the mega caps by far. The big losers were the banks and some of the cyclicals. So early in the week, we saw that kind of rotate a little bit, and people were doing some bargain hunting in the ones that got beaten up last week and taking some profits on the ones that did really well. But it's not a major theme. It's not like a rotation that I think is undergoing yet. Like we saw at the beginning of the year. In any case, let's take a look at regional banks. And quite surprisingly, compared to all the controversy going on, they actually closed the week up 0.2%, so almost flat. But if you look at this price action here, this is first. Let me just cover this. This is a symmetrical triangle, right? So an ascending triangle would have a flat trend line here and one coming up, sloping up from the bottom. A symmetrical triangle, like on its own, it has no price bias. It depends on, it's kind of like a picture of a fight between the bulls and the bears, and kind of nobody's winning, right? But it's also coiling up pressure. So whenever you see these, I think of these as like a spring. And as they come to the apex, when these two trend lines converge, you should expect to see price move out of that spring. But this is kind of like energy building up in a spring is how I look at it. So it depends on the preceding trend to give it its bias. So it has a bearish bias, and you can see that banks kind of broke down below that a little bit. It's not too far gone to potentially be a bear trap, but what's happening with the banks is they've got a really supportive factor in that the yield curve is steepened so much, but there's still this confidence crisis. So until Yellen or the Fed or somebody capitulates, I think the market is just going to keep pressing them on the banks, because I think the market is feeling like, this doesn't happen often, feeling like they've got the Fed on the ropes. Let's take a look real quick. Okay, so next up. Oh, some of the troubled banks, if you want to know, like right here, First Trust, FCT, right? No, wrong. PacWest Bank Corp, they're another one. Of course, about the European banks. B. Riley Financial, Texas Capital, Bank Shares, and Columbia Banking System. So these are some of the banks that, might keep an eye on, but I just watch the Regional Bank Index, KRE. Good enough for me. All right, moving on to the next page here. Market breadth I've been talking about. All right, so if you've been with me for a while, like the last year and a half or so, then you've probably heard me say quite frequently that I thought mega caps were going to rotate in and provide leadership for the second part of the rally off of the October low. Mega caps were really just stinking up the place from October to November, weren't participating well, but everything else was. The defensive sectors, the cyclical sectors, the Dow, all of those were leading. And my thesis was that we would see peak inflation and we would see peak Fed hawkishness. That doesn't mean a pause or a reversal in policy, but peak hawkishness, and the market would rally on that, which is what I would call like phase one. So if we looked at just the S&P's daily chart, actually the Dow it led the most. Don't need the moving averages. But if you look at the Dow in October, which is right down here, you got a little double base, a little double bottom. And this is that huge rally that was 20% and then Dow did nothing. So my theory was like somewhere right in here that, okay, now the mega caps are going to rotate in, and their edge is going to be, if we hit peak Fed hawkishness and peak inflation, then yields will start coming down. That's going to help the mega caps. But the other thing I thought was that money would come out of the cyclicals and go into the mega caps. So most of this year, I've been wrong on that. The money actually came out of the defensive sectors. And I also thought, because the money was coming out of the cyclicals, that market breadth, which has been really spectacular, would start to get weaker and weaker and weaker, like we saw during 2021. Had this huge bull market rally, all-time record highs like every month, right? But the worst market breadth I had seen in decades. And the reason why is because a handful of heavily weighted mega caps were leading the market and everything else was just not participating. So we're starting to see market breadth come down a little bit. Let me see if I can set up a chart real quick and I'll show you. It doesn't look nearly as good as it did. Yeah, this chart's not scaled perfectly, but I think you'll get the point. So let's go to Stock Finder here. And here we go. So what you're looking at is just the S&P 500 here. This is all-time record highs, by the way. December 2021. You can see the market breadth falling apart. It should be confirming or even leading higher. It's falling apart. And this leads us into the bear market that starts in 2022. We start to get really interesting market breadth right here. There's the double bottom. There's a positive divergence in market breadth. And this particular white market breadth indicator is just the percentage of NYSE stocks that are trading above the 200-day moving average. But I mean, look at this in like January or February. It's higher than at the peak of the bull market. We have like a better market breadth internal signal here because there was just much stronger participation. But recently that's really fallen. And what I want to show you is this theme that this market is getting more fragile. So if you're also aware of, all that stuff, you're also aware that I kind of felt like the mega caps would lead the last part of this phase one rally, this kind of celebration of peak Fed hawkishness, and market breadth would deteriorate rapidly, and that would probably be the end of this particular rally off these October lows. So what I want to show you real quick is like these little equal weight indexes that I just create for myself so I can just keep an eye on things. And I'm going to change this one. First, I want to show you the defensive sectors, right? And that's all it is an equal weight index of the 4 defensive sectors versus the S&P 500. And where you'll really see these, let me find the right time frame to make this look the best. But you can see them participating in the October rally. Here is the start of the new year. Remember what I said about the rotation out of defensive stocks and into the mega caps. So all of a sudden, these defensive sectors aren't providing the support they were. Well, this was fine most of the year. And this is where I was wrong because I kept saying, hey, I think it's going to come out of the cyclicals last year. And let me pull up the cyclicals real quick. So this is going to be like materials, financials, industrials. Consumer discretionary is a cyclical, but it acts much more like the mega caps just because it's like overweighted with Amazon and Tesla. So pulling up the cyclical sectors, again, it's just an equal weight index of those sectors. Okay, so here you can see again, them leading the rally off the October low in here, positive divergence. Strong breadth. I mean, they're leading over here. They're still doing well over here into the new year. This is where I was kind of like, I guess I was wrong about that. But look what's happened recently. So these are the banks primarily, and just kind of I think the market is sensing more that we're closer to a recession. So you want to own the cyclicals when we're coming out of a recession. That's like the first group that is going to start acting well. But this is not good. So this means there are fewer and fewer stocks that are participating. That's why market breadth is getting really weak. And all we have holding up the market right now, I mean, even I love the NASDAQ 100 over any other average right now. But even if you look at the breadth inside the NASDAQ 100, it's not fantastic. And the reason why is that there are, 6, 7, 8 stocks that are carrying the weight of everything. I have to zoom in a little bit closer because what you're seeing over here is how badly they performed into year end. Everything else was trading up here. They were going lower. So this was tax loss selling because these were some of the worst performing groups of 2022. But watch what happens when we come into January. They start taking the lead. If this was scaled correctly, you would see this white line above. But when everything else is breaking down over here, the defensives, the cyclicals, look what the mega caps are doing. I mean, they are holding this market together. So in my opinion, just looking at it from a price trend and the evidence and not like looking at, deep value or any of that other kind of thing. In my opinion, this is the only place to be if you're going to be long in the market. Speculative, then maybe the banks. And we'll get to that. I'll show you why. But I want to show you why market breadth is deteriorating. So you're seeing basically now half dozen, a dozen stocks that are basically providing support for the market. Okay, so let's take a look at that 530 yield curve. Here's another, and then we're going to get into something kind of interesting. So let me go to like, actually I just need to zoom this in a little bit. Sorry about this, and this looks a little wonky. I think my scaling's off here. Huh, maybe not. Okay, anyway. Oh, it's the banks. I need the bank symbol. There we are. This is what I was talking about. So this is the regional bank index here. And, before the banks crashed and had their little mini panic, this is what I was pointing out to my subscribers is that this yield curve leads the banks, and it was massively, massively flattened, right? And ever since that crash, the market is kind of assuming, the Fed is going to have to back off, right? And the yield curve starts steepening here. So remember, the yield curve tends to lead the banks. So right now, this is actually a good signal for the banks if they get that little bit of confidence, whatever it is, in a regulatory announcement from the Treasury or the Fed or whatever. But what they've offered so far, the market's not impressed with. It's not completely like puking everything out, but it's kind of saying, you've got a limited clock on this. You need to give us more. So that's what I see as an advantage for the banks. We can take a little deeper look at this if you want. Sometimes it's kind of hard to follow unless you scale it up correctly, but basically the gist is the yield curve leads the banks because of net margin interest. So you can see the yield curve leading the banks lower here, banks go lower. You know, over here, little positive divergence, bounce. Over here, negative divergence, boom. So that's just kind of the theory of it. And it usually works really good, except when you're in the middle of a crisis and everybody's kind of afraid to invest in these banks. And what's funny is like JP Morgan. So JP Morgan and all these big banks are really benefiting from the crisis. And what's happening is all the deposits are going out of the smaller regional banks because they're not too big to fail. And they're heading into banks like JPM. So JP Morgan takes those deposits, right? They pay 1/10% of interest on them. And then they take the deposit and they park it at the Fed and they make 4.65% interest on it. So, I mean, that's the scam. That's what's happening here. So JPM has got a big interest in these regional banks not doing well. So it kind of makes you wonder why some of the things that came out, like what Yellen said. Let me just check the comments real quick. Hey, Patrick. Like all your emails, friend. Adam, get me a fry, bro. Okay, so let's see what else we got real quick. The macro stuff. So the one other thing, let me just point out real quick. So if you look at this scale, and here you can see even better, right? You see the yield curve confirming, making higher highs, higher lows. Over here, lower high. So it's leading the banks lower. Banks come lower, right? From their all-time high. Over here, opposite. Banks get a little bounce. Over here, much opposite. Banks get a little bounce, but they can't hold it. So again, you know, it's just a good tool. If you like trading the banks, I would definitely have this. And this is just the 5-30 yield curve, a yield spread. Over here in white, right, is its scale. So as it passed 0 here, it moved out of inversion. So if you remember anything that I said about what happens in with the yield curve as far as recessions go from a macro perspective, this may be a good signal for the banks in the near term. If they can get some confidence, they could rally right up to that, you know, big relief rally. But from a macro perspective, it's not good. And I'm going to show you why. We're going to just pop over to a little slideshow I've got for you. And let me transition that. PowerPoint. Boom. Hopefully you'll be looking at that. So what you're looking at now is the 2-year, 10-year, the 2s, 10s spread. So this one, when it inverts, and invert means goes below this line right here, this 0 line, the black one. And by the way, these gray areas are recession shading. So these are US recessions. So here is inversion right here below the line. Since World War II, I think every time the yield curve, the 2s, 10s, has inverted, it has accurately forecasted a recession in the US. There's a recession. Here it is inverting again, recession, inverting again, recession, inverting again. Believe it or not, right there, it inverted. That's the COVID crisis, recession. We saw, as of, what was it, Wednesday, I think it was a Wednesday, March 8th, this yield curve, the 2s, 10s, was negative 107 basis points. So 107 basis points in inversion I think that was the most inverted since 1981, which is like the last time we had this major kind of inflation crisis and going through the same things. But the really specific point, a lot of people don't know this, and this is a really fine point. Let me get a drink of water, sorry. Is that after the yield curve inverts, that's the warning signal. That could be 6 months, a year before the recession comes, but that is the warning signal that it's coming. What happens is when the yield curve steepens out of inversion, that is the signal that a recession is almost imminent. Okay, so this tells you, yes, it's probably coming, or yes, it's very likely coming. This tells you it's getting imminent. Over here again, this is the dot-com bubble. You see the inversion, and here's that sharp steepening. There's the recession. Over here, the financial crisis. There's the inversion. There's the sharp steepening. There's the recession. Again, over here, inversion, sharp steepening, recession. So what the point is this 210 curve went from negative 107 basis points, right? As of March 8th, it's only negative 38 basis points now. So it is steepening. That's why, this last chart that I showed you of the banks, pull that up again real quick. For them, it's a short-term form of support because of net margin interest. So they actually could rally. So short-term could be good news for the banks. But for the economy, that is a sign that we're getting closer to recession. And obviously, the reason why is because, we're seeing financial stress in the system with the banks. And let me just tell you real quick why this steepens. The reason why it steepens historically, and most recessions, aren't ones that are born of like super inflation. We did have that in the early 80s. That was 4 decades ago. But most of the time, this is the Fed seeing that the economy is going downhill, and this is the beginning of rate cuts. That's what causes this steepening here. So why the market would be steepening right now, it's not because the Fed did a rate cut. It's because the Fed is really now looking like it maybe have one more in the bag, maybe, which is very different than what the market was looking at 3 weeks ago. So the bond market, I think, is signaling that they think the Fed is going to capitulate soon and that we're going to be in a recession soon. Fed doesn't care about a recession compared to inflation. The Fed cares about a financial crisis compared to inflation. That's the only thing that matters to them more than inflation, because if the plumbing of the monetary system breaks down, they can't transmit policy. Doesn't matter what they do if that policy cannot be transmitted. Okay, so let's go to the next slide. And this is an interesting one. This is the Fed funds rate in blue. They haven't updated it yet with the recent hike, so it would be a little bit higher up here, right? In that 5% range. And the red line is the 2-year yield. I have always said that the free market should just set rates, right? Because the free market is always, I hate to say it, especially the bond market, they are more correct than the Fed. But what I've noticed, and this comes from Tom McClellan's work I saw years ago, and then I just started doing some of my own research, is that when the 2-year yield crosses below the Fed funds rate, that is the bond market saying it's time to stop hiking rates. And I'm going to show you some other examples, but that's what's happened here, because this blue line would be up here around 5%, and you see the 2-year yield already crossed below it. So here's an example from right before the COVID crisis, right? Here's the 2-year yield trading above. The Fed is hiking rates, drops below. It's not the COVID crisis I'm trying to point out. What it is the Fed rate hike ends. When the 2-year yield drops below, that pretty much says, okay, the Fed is done hiking rates. That's the bond market telling the Fed, you really should be done. And here's another example. This is going into 2007, going into the financial crisis over here. And you can see again, Fed is hiking rates. The 2-year yield drops below that. Fed pauses and then starts cutting rates. Okay, so really interesting little indicator. And here is this is the dot-com bubble. So back here around 2000, 2001, Fed is hiking rates. 2-year yield crosses below the Fed funds rate. That rate hike cycle ends. So kind of a neat little thing, I think. I'm going to just check the comments real quick. Hi, Jennifer. Ken, good morning. Yeah. Ken says I was making really good money until Yellen opened her pie hole. I'm done. I was shaking my head. I was just dumbfounded. It's like, ah, what was it, like 2016 or 2017, something like that. Yellen said, "There'll never be a financial crisis in my lifetime again." It's like famous last words. Oh gosh. Okay, so let's go to, I think I might have one more slide. Yeah, one more slide here. And this one is the Fed's balance sheet. So, oh boy, whether the Fed wants to pause or not, this is the runoff, the QT of their balance sheet, right? I think I have specs here somewhere of how much. Let me see. Yeah. Well, I don't have the specs of how much they ran off over here, but they added another 94 billion to the balance sheet this week. That's right here. Basically, 2/3 of a year and some odd months of runoff of this balance sheet has been retraced in just like the last 2 weeks. This is primarily banks going to the Fed's facilities for them to get liquidity. So this is kind of the Fed has two main tools that they use right now. One is rates, and the other is their balance sheet. So because they had rates at 0% for so long, for 7 years after the financial crisis, it's like you can't cut anymore unless you want to go like Europe and go negative. And the U.S. banks that pretty much control the Fed are not going to allow that to happen. They're not going to allow negative interest rate policy in the U.S. So the only way to make the financial conditions looser is to buy assets. And the Fed basically prints money out of thin air, right? This isn't a lie either. I mean, I've actually seen, who was it? Was it Bernanke? Said, oh, it's easy. It's as easy for us as just adding a zero onto the balance sheet. That's it. That's it. Truthfully, they don't even need to sell bonds. I mean, it's kind of like a little bit of a joke, but they could go right into MMS or MMT, modern monetary theory, because that's essentially what they're doing. But in any case, with I think it's about every 500 billion in asset purchases is like a quarter basis point rate cut. So this is QE buying assets, and that was $120 billion a month. 80 billion of it was treasuries, 40 billion of it was MBS. We have a red hot real estate market, and they're buying mortgage-backed securities, right? I mean, what the heck are they thinking? 80 billion a month in treasuries. They can't buy them at auction because it is illegal. They would be monetizing the debt. So the primary dealers, JP Morgan, Goldman Sachs, Bank of America, the usual suspects there, they buy the bonds at auction, and then they offload them to the Fed. And then they take that money and then they put it into stocks typically, or risky assets. And that is why the stock market often follows the Fed's balance sheet. That's why in August of 2021, I pointed out to all my members on that very week that the S&P went from the COVID crash lows to that week in August, it had doubled 100% exactly. I showed the Fed balance sheet. It had gone from 4.1 trillion to 8.2 trillion that week. The Fed's balance sheet had doubled exactly the same week. So that gives you some idea. So here's the QT, the runoff. This is kind of like them cutting rates, you know. I mean, it's not the same effect for the stock market because it's really liquidity that these banks need to survive. And I'm sure they're not just tossing it into the stock market, but this is not what they want to be doing. So almost 2/3 of what they've done over the last year plus in rolling off that balance sheet has just been erased in a couple weeks. So Let me check the questions real quick, or comments. Oh, no comments. You guys are a little tired this morning. I am. Okay, finally. So we went through the macros, we went through the market breadth, we went through what's holding up the markets, the regional banks. They have an opportunity. I think this whole Yellen meeting on Monday just came out to be a nothing burger, but we'll see. We went through the averages. So is there anything anybody wants to look at? What sectors will perform in the recession? During missed most of it. Adam, it will be the live stream will take an hour or two probably to process, and then it will be back up on YouTube, and you can watch it there. I'm not going to do a video of this one. I'm not going to like chop it up because it's really not that long. D. Frank, what sectors will perform in the recession? Okay, so typically, you ready for this? Typically, early in a recession, it's going to be the defensive sectors and typically consumer staples. Now, this is relative performance. Relative performance doesn't necessarily mean they go up. It just means they go down less than everything else. One area that tends to do well, it did horrible last year, and I'll tell you why, but one area that tends to do well is the large cap tech and like the mega cap stocks. The reason why they tend to do well is because they have fortress balance sheets. It's because they, unlike cyclicals are, that's cyclical. They move with the economic cycle. So if we're entering a new economic cycle, like a new expansion, there's going to be more building. So building material sector is going to do well. There's going to be more use of energy. So energy does well. Financials, industrials, so stuff like that. But in recession, those are the ones that are going to pay the most. They're going to be hit the hardest. The sectors that usually do the best are going to be the ones that have the mega caps. Technology and communications. Consumer discretionary is another. It is a cyclical though. But because of the weight, I mean, if you're actually trading XLY, the sector itself, because of the weight of Amazon and Tesla, the whole sector just acts like them. But it's got a lot of stocks in it that are consumer discretionary, like should I buy a new, sports car or RV or whatever. In a recession, typically those don't do well. But because of the mega caps, they do. So yeah, believe it or not, during a recession, it's usually the mega caps because they're secular growth. So basically, you're not going to buy it. You might say, we're in a recession, I'm going to dial back a little bit. Maybe I'm not going to buy a new RV, but you're not going to stop using Google. You're not going to stop using Apple. You're not going to stop using Facebook. So that's why they're more considered secular growth, more immune to the cycles of the economy. Let's see. Adam, liquidity going to pull the markets up, I think. So I was just explaining that, this chart of the Fed's balance sheet that's just exploded is liquidity. And anytime over the last 10 years, this would have led to a huge rally. This liquidity, though, is not quite the same as what we've seen over the last 10 years where it was going to the banks and then going into the market. This is kind of going into the banks and they're kind of holding on to the money out of stress. So, but they may be taking more than they need and they may be investing some of it in the market. It's really difficult to tell, but this is just as of Wednesday. So we don't even know what Thursday and Friday was, but that's pretty remarkable for the Fed to take a year to reduce this balance sheet just this much, and in a couple of weeks, 2/3 of that's retraced. So it's a problem. It's a problem for the Fed. Let's see what else is here. The Fred chart, where could I find that chart? Okay, so Fred is the St. Louis Fed. So just Google. The symbol doesn't work on my trading platform. Yeah, you have to go to the St. Louis Fed's website. So Google St. Louis Fed, and then you can put in FRED if you want. Put in what you're looking for. So if you want to look at the 2s 10 spread, right? 2S minus 10S, and then like Fred or St. Louis Fed, and it'll pull that up for you. Or their balance sheet would be like all assets, and that will pull that up for you. And then you can put comparison symbols on here too, like I did with the 2-year yield moving below the Fed funds rate. I showed a whole bunch of examples of that over here, where it tends to mean, the bond market is telling the Fed stop. And you can see rate hike cycle does this, they stop. Again, go back here to 2007, 2008 financial crisis, big rate hike cycle, 2-year goes under, Fed stops, pauses, right? Then they start cutting. Again, this is the dot-com bubble. Fed's hiking rates, 2-year below, Fed stops. So I'm just making that point that that's what pretty much happened this week. So you can add symbols to it too. It's not the greatest resource. If you have spreadsheets and stuff, you can actually import the data into Excel. And if you're good with Excel, you can do your own charts, which if anybody is, I would love to talk to you, because there's some that I would like to do. Let me take a look at the other questions. Brent, don't you feel this feels similar to the early 90s recession where SP 500 dropped 20%? There was a high inflation, bank troubles. However, the markets rallied after due to liquidity. Similar to the early 90s. Adam, I haven't really looked, to be quite honest, because this is like, with the inflation situation, it becomes more similar to like the early 80s. But nothing, it just, no two bear markets are alike. So I think I've had this view of, hold on, let me just jump in here with you guys. So I've had this view that we have basically 3 phases that we're going to go through. And phase 1 was that the market would rally and kind of go into a lateral range. And that was, sorry about all this movement here. And that was basically looking for the pivot, not the Fed actually pivoting from rate hikes to rate cuts, but max like Fed hawkishness, which came with max peak in inflation. So I think that rally is getting towards the end. I think the mega caps can, wow, I gotta just kind of keep myself still. I think the mega caps can lead it. They did it all of 2021. It's not out of the realm of possibility at all. But the general situation in the market is breaking down, with market breadth just a lot worse than it was like a month ago. So there's that. Let me see, look at the rest of the question. It's one of these things where every time the Fed hikes rates, they break something every time. And that usually means like their rate hike cycle is over. The thing is, you never quite know where it's going to be. 2007, you could tell, 2008, you could tell the housing thing was a big issue. But a lot of the times, you may have something where a bank goes and then another bank goes, and then it has some unintended consequence in some far off part of the economy that no one saw coming. So it's really unpredictable in that sense, like where the weak links are in the economy. And this is why the Fed is so scared, because it's something they can't really predict. Obviously, they didn't predict the banks, did they? They regulate them. They didn't predict it. They were regulating that bank. Silicon Valley Bank, they were like right in the middle of it. It failed. So next question, Adam. When the yield curve steepened sharply, there was a steep rise in unemployment. 20% was about it. Even when the yield curve steepened sharply, there was a sharp rise in unemployment, etc. 20% was about it. Yeah, right now for me, the yield curve rising is just like a macro signal that I thought we'd be like seeing those signals more towards like the second half of the year. With the bank crisis, it's like bringing them forward. Dollar stores tend to do well in a recession. Yeah, they charge $1.25 now too. Thanks, Frank. Appreciate it. My big concern is tech, safe haven. Can you review what XLK looks like on 3C? Missed that. Came late, but technically I see new divergent highs. XLK dailies without. Okay, let me see. Let me see if I can get XLK up. I gotta change my charting software here. Just zoom it into there. So XLK, it's not going to be an exciting chart. I'm going to tell you that. But let's see, stock finder. But it's a good chart. So what we're looking at is XLK, the tech sector. And 3C for the most part is confirming. You can see like over here, it didn't confirm this high and we got like a little consolidation. That was actually a bull flag though. And towards the bull flag, look, 3C is like, boo, money's coming in. This is what you want to see. Quite often, when you hit a measured move, you're going to see a consolidation, little bull flag right there. And you're going to see 3C do something like this, like, okay, we met our measured move. This is going to be the start of the consolidation. When you know it's like a really bullish pattern is as it develops, 3C starts showing money coming into it right before it breaks out. But all of this over here is confirmation. I think tech will do fine, can do fine. It's just broader risk sentiment right now. Everybody's freaked out about the banks and how that could spider web out. I think probably more impressive to me is the actual price action. For me, 3C is a tool. It's not like a holy grail. So what I look at is what I give first priority to always is price action. And then my tools try to help me determine what price action is going to look like. So I'm going to just transition real quick to the tech sector. And again, what you're seeing is like the same thing as the NASDAQ. This is the flagpole for the bull flag. This is the bull flag. This is one of the few that survived. Remember, they started small. They grew. This held into it. It's broken out. If you look at the mega caps, so this is the technology sector, which incorporates a lot, like semiconductors. They have a bull flag. They've broken out. Mega caps. This is the mega cap index. You can use whichever one you like, but I just try to keep it consistent using the same one. Another bull flag. They've broken out. If we look at the communication sector, bull flag. This is a mega cap heavy sector, which is why I bring it up. So like Facebook, Google, Alphabet, they're in this sector. And consumer discretionary is probably my least favorite of them. I haven't updated the trend lines here, but again, it's got a lot of other stocks in it that are really susceptible to a recession. But when the fortress balance sheet mega caps, rally, it will pull this sector out. This is why I don't really group this sector as a discretionary sector, but I lump it in with the mega caps because it acts much more like them. So yeah, I like the price action a lot. I don't know if you saw the earlier chart. NASDAQ 100 is pretty much the average that's going to benefit from them the most. And what I was saying earlier, if you missed it, was that even NASDAQ 100 market, its breadth, like the internals, we don't have as good a participation, but that didn't matter. The whole premise was that because of the weighting of those mega caps, that they'll move the market on their own. In fact, I was expecting market breadth to not be good. So, I'm all over the place with this camera, aren't I? All right, anyway, so let me take a look at some of the other questions here. Wait, let me just look at Patrick again. Missed that, came late, but technically I see new divergent highs on XLK dailies, RSI, MACD, confirm. Yeah, so what I showed a little bit earlier, Adam, was the NASDAQ 100. So this is great, a great start to a breakout. But if we go back a little bit, it's running into resistance at its former high. I'm going to have to go to a daily chart to show you. So this would be the bull flag here, 200-day support there. here's kind of the breakout from the bull flag, but you can see that resistance right here. So NASDAQ needs to trade, NASDAQ 100 needs to trade like above 13,000. So once it does that, this bull flag can really see that second leg take off. And that's where the juice is, because this is kind of the measured move. I could go, probably from like here for a conservative measured move, which is 14%. So you take that from the actual breakout point and add it from there. Okay. A more liberal interpretation, and it's hard not to make this interpretation because that's a pretty linear advance, but a more liberal interpretation would be, 18.5, 19% from the breakout point. So if we look at the breakout point, if you guys want to do this exercise with me real quick, I'm just showing you how I come up with, measured moves. Actually, I have to rescale that. So what did I say, 18%? I'm gonna have to come down a little bit more. So you take it from the breakout, right? You want to use a log chart. You can do it by counting points, but I just find this a lot easier to measure the percentage. So 18, 19%, you're like looking at 14,550, something like that. So it has huge potential, but it does need to overcome this area here in 13,000. All right, being short bonds, I have not noticed that one. Okay, hold on, let me back up. Sherry, what I have noticed in bonds and note futures, they are not trending but are very volatile. Yeah, that's because bond market volatility, the move index is off the charts. I mean, it's insane. So that's just the bond market is repricing in a whole bunch of new stuff, right? Bank failures, potential bank failures, what the Fed is going to have to do, what other national or international central banks are going to have to do. The bond market has just been insane in volatility, but the general trend is, like I showed on the TNX chart, the 10-year yield I pulled up here in the background. The general trend is that yields have broken down from this really hot trend. So as long as this keeps going lower, it kind of means two things. One, we're repricing in, back here, we're looking at a 75 basis point rate hike as like a certainty just this past week. Coming into the week, we weren't sure if we were going to get 25 basis points or a pause, and that depended on how the banks acted early in the week. So for me, for the mega caps, as long as, we stay probably below like 3.75%, that window of opportunity for them to rally is open. Okay, let's see what else we have. And Sherry, usually yields and commodities do trend better than stocks. Actually, a lot of trend traders will trade commodities and yields in fixed income because they do kind of tend to trend better. Being short in bonds, I've noticed that. Okay, short TBT, that is. Hey Brent, thanks for doing another live stream. You're welcome, B Rent. I'm glad you made it. You too, Adam. Glad you made it. Did you get me a fry? Thank you. Small, long on MGK in profits. Okay, cool, B-Ren. Cool. Question on your TC layout. What is your FX 500 scan in fixed rate R panel? That's nothing. I don't use that. It was just up by accident. I don't use TC 2000 for any of my scans, actually. I use TC 2007 and StockFinder. I like TC 2000 because I can draw on it easily. That's the truth. Question, let's see. You were thinking mega caps were looking bearish on Friday. Yeah, so okay. The one thing I didn't like, and like I always say, a day is not a trend. So it's not like I'm going to, get too worked up about it. I could barely even see it here anymore, but Friday morning, it was kind of looking like, was it mega caps? Was it XLK? I can't remember. It was kind of looking a little bear flag-ish, like right over here. Really, for a bear flag, you need like a upward slanting parallelogram. So this is kind of lateral. But yeah, there was one that was bothering me a little bit. It was just something I mentioned, and it was intraday. It wasn't like a trend. It wasn't like a clear, like I'm looking at this, I don't see a clear bear flag. Like I was starting to see hints of it early Friday morning. So I'm not as concerned about that. The only thing I don't want to see is, like this bull flag be violated, trading below like 195 on the mega caps. I mean, it can do that and survive, but it's not a good sign. So basically our next measured move for the mega caps, just coming off, not even talking about the big bull flag, but just this one is, let's just say 4%, right? So from there, probably going to need a little bit more space. Measure it right from the breakout. Right there, go 4%, 203, nice round number. But that is just, these small bull flags that I'm looking at and giving you the measured move for. This big one, I mean, that's the juicy one. So whether it's conservative measurement here, 13% from a breakout point right there, or whether it's a little bit more liberal, where we're talking about, 19-20% from a breakout right here. Yeah, I think they have a lot of potential. It's the only thing I've liked in this market this entire year, and they've outperformed everything like by far. Let's see how much the mega cap index is actually up year to date. Let me see if I can pull this up real quick. So here we are, 30th, right? Yeah, okay. Opa. This will be interesting because I want to show you. So I always compare it to the equal weight index. It's up 15% year to date. The S&P equal weight index, there's a few you can use, but I just use this one. And here is or the end of the year. Sorry, a little fumbling here. I get the dates right. Yep. It's down almost 2% for the year. So mega caps really kicking ass. I mean, it's not just about being in something that's making money, especially if you have like a long-term portfolio and you need to move money around. It's about not losing money. And sometimes it's just about, if you're in a situation where you can't get out of something, it's about losing as little as possible. So you want to be in the areas, the sectors, the averages, the asset groups that are acting the best, if you have to stay invested in the market. So, this is why I've been like pounding the table on mega caps all year. Sorry guys, let me take a look at the questions again. True rate of return scale for price could help you determine target move. Select where you have log bottom right. Yeah, getting log right over here. Okay, Mark. Russell showed the strength yesterday as it fights the 2000. Yeah, so Russell, to me, the most interesting thing was that it survived this test of last week lows. So, if you're using IWM, that's around 171. So dip below that on Thursday. Thank you, Yellen. Right from here. So remember, again, like the S&P, this was a bull flag that failed, right? And it's no longer a bull flag. I don't view it that way, but these channels, these trend lines are still playing a major role in price. So you can see they're bumping into it. They're finding resistance there, resistance there, resistance there. Finally, they break down below that a little bit, like a little troublesome Thursday. But by Friday, they closed back above. So they're still waiting for the Fed and for Yellen, the Treasury, to basically give them something that they feel a little bit more comfortable with than what they've gotten so far. You also mentioned the rally will likely last until the... Okay, so that's my Dennis Rounder's question, Rounder 1944. You also mentioned the rally will likely last until the end of March. That is quite a move in 1 week. Yeah. So my thought, and this is going back to late December and early January, kind of before we even knew the mega caps. Like we had hints of it, like we could see it 3C, but before the mega caps actually rotated in with price performance, which started the beginning of January. a lot of times what will happen is like these hedge funds and stuff, they'll reallocate their money, or they'll kind of change their portfolios. And when they'll do that is at the end of the month, typically, and the end of the quarter. So my thought was, that they'll probably stay involved until, why am I having such a difficult time with this camera? They'll probably stay involved at least until the end of the quarter, which is the end of March. If they see, no better alternative, if nothing happens with the banks, it's like, where do you want to put your money? They have to be invested. It's going to be in the balance sheet, the fortress balance sheets, which are mega caps. And if yields are coming down, then there's not that rate risk that there was all last year. So I think they could potentially, keep going for maybe another quarter. Maybe it's just another month. I don't know. But I don't think they're done. If something does come out, right, and the Fed or the Treasury give the market some certainty that they're going to really stand behind these banks, if something like that comes out, then my guess would be that there's going to be a rotation to the banks. But I would guess it would be short, like maybe a month, just to catch up to, let me pull this chart up real quick again, just to catch up to the yield curve. And I'll just transition this so you can see what I'm talking about. Again, I was talking about this earlier, how the yield curve was giving us a signal in that it was leading the banks lower. This is the regional banks. Here's this sharp steepening. So this is a signal leading it higher. So my feeling is, if we do see some confidence in the banks, and they kind of look like they're just in this waiting pattern with a bearish bias, saying you haven't done enough yet. If we get that, then, and it's interesting that KRE, it didn't break down. It held that low. It's not giving up. Then we could see some rotation out of the mega caps, or maybe out of something else, and see the banks rally up. That would be a relief rally to me. It would be something that I think would be fast, strong, but not lasting, if that makes any sense. Okay, so any more questions? Your analysis on gold. Gold, okay. Yeah, let's pull it up. So gold has been acting really good. This week it was flat. Hold on, let me pull a couple things off here so this chart is a little cleaner. So, and I need to transition it, don't I? All right, we're going to go to Thinkorswim. So you should be looking at gold futures on Thinkorswim. Yeah, still having this problem. One of you tried to help me out with this percentage thing, but every time I change it, it just goes back to percentage rather than price. In any case, gold, that's a dollar. Oh, let me point out the dollar real quick. It's also in a supportive position. So I kept on talking about window of opportunity. Remember that spike in yields in February? Dollar did the exact same thing. It's right here. So that trend line broke down, got a back test of it. Now we're seeing the dollar trend lower in this kind of minor trend, lower highs, lower lows. So this is another window of opportunity for stocks to rally, probably the mega caps, because they look the best right now. But this is another window of opportunity. Also for gold. So gold has had the same really high inverse correlation to the dollar and yields, same way stocks have. So let's pull up gold real quick. You see how it just changed back to percentage? So annoying. So annoying. So gold, look at this huge move, right? Part of that is flight to safety, because gold is a traditional safe haven. But part of that is the collapse in the dollar and the collapse in the yields with the collapse in the banks. But gold's got a real tough time right here at 2000. It's kind of more of a psychological level than technical, but there's definitely some technical aspects to it, but definitely these round numbers like 2000 or 13,000, they always have a psychological component. So if we look, pretty closely at what gold is doing, it is kind of doing this. I don't have, I'm not good at drawing on TOS. I always screw up the trend lines, but you kind of have a ascending triangle. So you have a flat trend line here right above 2000. You see it doesn't want to go through 2000. It kind of trades above it, comes back down, trades above it, comes back down, trades above it, comes back down, but it's acting well. If we back out a little bit, look at the volume, you know, when it starts rallying, that's what you want to see. That's the kind of thing you want to see. Over here, where volume falls, you want to see like a consolidation. But over here, let me go back to the 15-minute chart. What I think we have is an ascending triangle. So that would be like the upper trend line just above 2000, and the lower trend line is sloping up like this. That's a bullish price pattern. So gold looks like it wants to rally higher. Gold would be, and Bitcoin, if they take off even more, that would be a pretty strong indication. They're kind of like the QE assets. That would be a pretty strong indication that those markets, and I'd pay more attention to gold probably, are expecting the Fed to capitulate soon, whether that be on the balance sheet, which essentially they already have, or on rate hikes. And, you know, Powell set it up in the press conference. Powell said, basically, we may not have to do any more rate hikes because of this mini crisis in the bank or in the banks. That's going to cause them to tighten their lending standards and credit. So that is going to tighten financial conditions and squeeze the economy. So the Fed is kind of, I think, maybe hoping that they won't have to raise rates again. But if gold breaks out above 2000, that's pretty much telling you that the market is really thinking that that is likely. And I think the market has, usually 95% of the time, it's don't fight the Fed for very good reason. You know, you don't fight the Fed. Look at their balance sheet, put the S&P 500 over it, and you'll see they track nearly together. You know, the Fed throws money into the markets go up. The Fed takes money out of the markets go down. That is like, if you do nothing else, if you know nothing else about technical analysis and you're just managing a portfolio, remember that. Okay, if the Fed is tightening policy, you want to be like, you know, if you have the opportunity, maybe out of the market or somewhere safer. When the Fed is cutting rates, that's the time you want to get back in, when they're adding to their balance sheet, because they're putting money in the market. Let me just check any other questions. Okay, I think that's it, guys. What do you think? Unless there's any other questions. And if there is, you know, you can always leave them in the comment section below, or you can always email me and I'll put the support email below. And I'm going to check those just one more time. All right, cool. So everybody stand by for my super splashy little exit. Have a great weekend, everybody. I'll see you guys on Monday.